Welcome everyone. Before I start this session is recorded and will be shared to you via our LinkedIn page, DD Consulting. Good afternoon, everyone. Welcome to our highly anticipated webinar on IFRS 17 Phase 3. My name is Rahim and I'm your Regional Marketing Manager at DD Consulting, and I'll be your host for today's session. DD Consulting offers actuarial risk management, IFRS 17, fintech services in countries like Oman, Saudi Arabia, Pakistan, India, Nepal, and UAE. Through our group entity, Base Actuarial Solutions, we offer our services in Malaysia, Cambodia, and other countries in Southeast Africa. We are delighted to have you all over here with us. This webinar aims to provide knowledge about IFRS 17 Phase 3, as well as insight about an impressive lineup of speakers who are expert in their respected fields. Before we dive into the content, let me brief walk you through the agenda for today. We will begin with an overview of IFRS 17 Phase 3, followed by presentation from our esteemed speakers. There will also be a series of demos to provide you with practical examples and applications. Two special segments have been included, one covering implementation experience from client perspective, and another one on FAS 4243 to give you the latest update on its front. We will conclude with a question and answer session where you can ask our speakers any questions you may have. Even in between, if you have any question and answers, you can always write in the chat box and we will reply to you. Without a further ado, let us formally start our program. DD Consulting is providing insurance market review reports for various countries. And today, our first speaker, Mr. Uzair Khurshid, who is a non-life actuarial expert, will talk and give a brief overview of Pakistan general insurance market.
Hello everyone, my name is Zair Khurshid and I am working as a senior actuary analyst with DD Consulting. I am here to talk about the performance of the Pakistani general insurance market for 2023. For our analysis, we have considered all listed insurance companies on the stock exchange. These amount to a total of 16 companies. Furthermore, we have considered the combined portfolio of companies wherever applicable, consisting of their takaful and conventional businesses within Pakistan. It is worth to mention that the general insurance share of conventional businesses for the overall market stands at about 89%. I will be talking about the key performance measures of the insurance market alongside their growth with comparison to 2022. As you can see from the chart, the top three contributors in terms of gross written premium are UFG General, followed by Adamji Insurance and Jubilee General Insurance Company Limited. These aggregately contribute to about 68.1% of the total market. Moving forward, the gross written premium has shown a significant growth of about 26% from 107.8 billion PKR to 135.6 billion PKR in 2023. A large part of this growth is driven by the price increase due to high inflation and depreciating rupee value during the year. We can further see from this chart that with an increase in gross written premium, the net earned premium and insurance claims and expenses have also increased. However, the increase in earned premium is more than the increase in costs, hence improving the loss ratio from about 53% in 22 to 50% in 2023. This has also in turn driven the combined ratio to decrease in 2023. Another thing that was observed during our analysis is that the investment income can be seen to substantially increase by over 75% over the years under study. Moving forward, all the factors discussed have contributed to an increase in overall profitability by 78% from 12.5 billion PKR in 22 to 22.3 billion PKR in 2023. As illustrated by the chart, we can see that the highest profit has been recorded by EFU General, followed by Adamji and Jubilee General Insurance Company Limited. It is also pertinent to note that Premier Insurance and Asia Insurance has shifted towards profitability over the year, as seen from this graph. This was the overview of the industry's performance for 2023. Moving forward, I would also like to discuss the innovation in the market. I am referring to digitization. Digitization is increasing every year, but there is not enough information available to show how much of new business is being written from this distribution channel. Previously, we have seen that group and corporate businesses from companies and brokers dominate the distribution channel in Pakistan. Right now, Pakistan's insurance sector is in its initial stages of digitization. While there is significant and huge potential, the industry is currently facing challenges in adopting digital technologies. These include digital literacy. This is basically a significant portion of the population being targeted faces difficulty in understanding insurance products and procedures online. The second one would be cybersecurity concerns. This refers to a lack of trust on digital platforms and data security by the population in general. The third would be infrastructure limitations. This pertains to the absence of robust internet connectivity and digital infrastructure across the country. However, there are also many opportunities that lie untouched in the area. For example, the digitization space is an untapped market. With little competition in the digitization space, there is significant potential for insurance companies to benefit from. Secondly, would be data and AI driven innovations. These basically include data driven analytical insights and AI powered solutions, such as predictive modeling and handling of claim protocols by the use of AI. The last would be SECP support. The SECP has introduced regulations in support of the adoption of technology in the insurance sector. These regulations provide a framework for insurers to operate in the digital space. That was all regarding the Pakistani insurance market of 2023. Now let's talk a bit more about DD Consulting. Currently, we are providing industry insights on many emerging markets such as the UAE, Qatar, Pakistan, and Sri Lanka. To get a copy of our full report that consists of about 30 pages on the Pakistani insurance industry or any other industry, please contact Mr. Rahim Aziz by sending us an email at support@digitsdata.com. Thank you for your time. Over to you, Rahim.
Thank you so much, Mr. Uzair. Now we will call in Mr. Hamza Saud, who is experienced actuarial analyst and specializes in IFRS implementation, financial impact assessment, and actuarial audits engagement. He will talk to us about IFRS 17 requirement and templates applicable in phase 3.
Thank you, Raheem. Hi, everyone. Hope all of you are doing great. And I'm pretty sure by the end of this session, we will have a clear picture that where we stand in terms of IFRS Phase 3 IFRS 17 implementation and what is the way forward when we enter Phase 4 of IFRS 17. So we do have different speakers who will be catering different topics, which is going to give us a holistic view of IFRS 17. Also, we do have two of the vendors who will be giving their demos on IFRS 17 tool, which is going to help the company's representative who are part of this session to make informed decision while finalizing the IFRS 17 software. So coming back to the topic, which I'm going to cover is to outline the requirements and approach and methodologies for the successful execution of phase 3. Now I'm going to briefly give you a background of IFRS 17. As most of you are already aware that International Accounting Standard Board introduced IFRS 17 standard in May 2017, and globally the effective date to report under IFRS 17 was from 1st January 2023. However, in case of Pakistan, SECP mandates the reporting under IFRS 17 from 1st January 2026. So still we do have some time to figure out things at our end, but I believe it's going to be less challenging because IFRS 17 has already been implemented within different markets. So we can take help from them by studying their market and what challenges they had faced while implementing. Um, Also, SCCP has followed the same approach which has been implemented in various other markets that, dividing the IFRS 17 implementation into 4 phases. Phase 1 is gap analysis. Phase 2 is financial impact assessment. Phase 3 is system design and methodologies. And the final fourth phase is parallel run and the actual implementation. But our current focus is on the importance of phase 3 execution since the SECP deadline is approaching. So, talking about the submission requirement, we need to submit two key items to SECP. One is a report, which should be titled as IFRS 17 Phase 3 System Design and Methodology, along with the company's name. Then the second item is Phase 3 template, which has to be filled by each company. So there are three main objectives for this. One is to have policies and procedures in place for IFRS 17. Second is that the company should identify and select the required software. Then the third one is that the company should establish a work plan for producing and publishing IFRS financial statements which are compliant with IFRS 17. And the deadline date for the submission is 30th September, which is even less than 2 months as of today. As discussed about the two items, under report, there are four broad sections which have to be covered, which I'm going to discuss in detail one by one in the following slides. First one is data consideration, in which you have to figure out the current data status, as in what sort of data is available with the company as of now. And you have to even formally produce a data dictionary for IFRS 17 implementation. You have to clearly define what sort of processes will be followed to transform the data, how the data will be collected, how the data quality will be maintained, and at what level the data will be produced, for example, gross NRI or the granularity of the data, as in, is it going to be produced at policy level, product level, etc. Second section is about system and operational design, in which you have to clearly outline the plan for IFRS 17 calculation and, if necessary, actuarial projections. The main focus is around system integration, in which you have to provide the detail regarding the integration between the systems, administration system and new tools, either acquired or developed for IFRS 17. Also, you have to identify any enhancement required to the current system. So there are three key points. One is IFRS 17 calculation and actuarial modeling. Second is, explaining the architecture and process flows. And the third one is, suggesting system enhancement. In this slide, I just want to point out one thing is that, ICCP allows the company to have either Excel-based solution or IFRS 17 engine to produce the number. However, SCCP expects the company to finalize their decision well before the submission of the report. But the company doesn't need to have a contract with the vendor in case if they opt for a particular software. Third section is about policies for methodology, in which you have to set out decisions on the technical methodologies, policies, and procedures for key IFRS 17 component. Um, Among these components are accounting and actuarial policies. Second is you have to provide a summary of methodologies to implement those adopted policies. Then the third one is, you have to provide a description of processes which have to be implemented. So overall, you have to summarize final decisions under the methodology paper, which then can be referred for internal use or for regulatory reviews. Here is the further breakdown of the components that are part of technical paper. Under basic requirement, you have to define key terms and definitions. You have to discuss about the contract boundary, cover the section of unbundling of investment components from insurance contracts. Under the cash flow section, you have to define how will you be deriving fulfillment cash flows. Under IFRS 17, risk adjustment is also a part of fulfillment cash flow, which is a replacement to prudence margin under IFRS 4. Then under level of aggregation, you have to clearly define your portfolios, current portfolios, and their profitability status. And then you have to segregate those according to cohort wise, is that underwriting year 2021, 2022, etc. And for profitability, you have to perform onerosity testing, in which you have to evaluate on the basis of combined ratios. If the combined ratio is above 100%, then you term that portfolio as onerous. Under discounting mechanism, you have to define methodologies and how will you be deriving the final yield curve. There are two methodologies. One is top-down approach, and the second one is bottom-up approach. And most of the companies, I would say 95% of the companies are using bottom-up approach to derive the final yield curve. There is also section about regarding risk adjustment, in which you have to provide the final decision regarding which method have you applied for calculating risk adjustment loadings. Then there is a section of measurement approach, in which there are three models. One is premium allocation approach. Second is general measurement model. Third one is very variable fee approach. And VFA is mostly related to life products that are unit linked. However, standard by default you have to apply GMM model, but standard allows you to perform P eligibility testing if a particular portfolio passes the P eligibility test, then you can simplify your calculation by applying PA model. Then there is a section of reinsurance which you have to cover in detail. Then there comes a section regarding contractual service margin, which is applicable if you're applying GMM model to the portfolios. Then you have to define loss component, how will you be calculating the loss component and when will it be applicable. Then the section is about presentation and disclosure, in which you have to define and provide a sample of how will you be presenting your financials and disclosures. Then the final section is about transition, in which there are three methods. One is full retrospective, second is modified retrospective, and the third one is variable fair value approach. And it depends on the company's data structure that which method suits them the most. Fourth and the final section under the report is governance, in which you have to outline the governance structure for IFRS 17 implementation. Then also you have to provide a detailed work plan for addressing any changes. You have to. There is a section also regarding human resources requirement and training plans. Then you also should cover the budget plan, in which you have to present clear budgets for IFRS 17 implementation. Now, due to shortage of time, we are not going to go through the phase three template, but then again, I have listed down six sections which are covered under the phase three template. One is company information, in which you have to provide basic details about the company. Then the second is business statistics, in which you have to mention about your current portfolios and their respective premium written during the period. Then the third section is about data dictionary, in which you have to fill out data fields and their definitions. Then the fourth one is about vendor assessment, in which SSCP has provided a few standard questions which can help the company to assess the vendor. But then again, company can add their own questions within the template. Then the fifth section is about methodologies, in which you have to provide description of methodologies that have been finalized for the IFRS 17 implementation. And the final section is about governance approval, in which you have to provide set out steering committee and their functioning roles. You have to provide a timeline for each component under the IFRS 17, and you have to also provide a clear budget plan for the IFRS 17 implementation within this section. So these are the six sections which have been covered under the phase three template. And that's it from my side. Over to you, Rahim.
Thank you so much, Mr. Hamza. Now we will call in Mr. Hassan Salim, who has 11 years of experience in financial services sector, specializing in risk management and both external and internal audit. He will cover insights from insurance company viewpoint and share his experience on implementing IFRS 17.
Yeah, hi and good afternoon, everyone. Hope everyone is fine and good. So, thanks, Rahim, for the introduction. Just to start over here, I serve as a head of internal audit and compliance in Al Dhafra Insurance Company. It's one of the listed entity in Abu Dhabi stock market, and we just complete the journey of IFRS 17, which you are going to do so. So I have some points over here which will help you a lot in planning the journey of this IFRS 17 actually, because if you just see the standard itself, so you see like it's more actuarial standard rather than the accounting standard itself. So we just started this journey in 2019, and our regulator is the central bank actually. So the points I will just cover over here, so it will help you a lot to prepare yourself for the IFRS 17 implementation. So by the start of the journey, we just submit some gap assessments report, which are the one of the initial step, and the financial impact assessment to the central bank. During this phase, consider 2019, 2021, and 22, the companies which are listed and been registered in United Arab Emirates have done 4 years impact assessment. So these assessments are the part of implementation process. And other than this one, We are submitting quarterly progress reports to central bank, like what we are doing in the IFRS 17 in terms of consultancy, in terms of advancement and the tool implementation itself. The initial guidance from the central bank is should be like there should be a gap design and the implementation for the insurance companies. This is very crucial for insurance companies, and I prefer to remain on one consultant whatsoever. So what happened over here when we just started this 2019, few hurdles are over there actually to analyze the consultants and other thing. Uh, so in that sense, I'm just saying like it should be one consultant at all the time, which helps you in gap design and implementation process. So it will be very easy for the company when they reach the finalization stages of the implementation. Now, when we are looking for IFRS 17 implementation, so definitely the most important thing is the actuarial consultants, the automations of the tool, and the core application of the company itself. So this is the one of the most important and appropriate tool. So this is to be analyzed by the companies in the gap assessment phase, because if you get delay, so it will not help you in the future itself, because the implementation, since we get like 3 years, even though we believe like it's a very less time, and still the companies need a lot of time to analyze the things. When we are analyzing the consultants, we get to know, and there's a requirement from the central bank, like there are two options are available. Once, either we can just go for a tool like IFRS 17 tool, which can be synchronized or linked to your core application and extract the data and generate IFRS 17 disclosures. Or either there is a services like a managed services. Either you can just go for software purchase or managed services. In managed services, the best thing, like there's less cost is involved, and the appointed actuaries or the consultants can provide you these sort of services. Like in UAE market, there are 61 insurance companies, 28 like local national insurance companies, and the rest of are the foreign branches. For the foreign insurance branches, which has having less expenditure want to do, so it's a preferable to go for the managed services. One thing I want to highlight over here, so both the methodologies are being accepted by the central bank. The next point which I want to highlight over here, so whatever you are doing for IFRS 17 implementation or the gap assessment, it is very recommended to, develop the technical papers. So this is one of the first and initial requirements when the external auditors are going to ask. So they will be relying on your technical document and the papers itself. So we just had the same journey, and we are being audited by one of the big fours also. So once we just started this IFRS 17, implementation are being completed, and we are publishing our financial statements. So most important thing is the technical paper. Uh, the transition results also very important. We just publish our financial statements in 2023, which are on based on the IFRS 17 standard itself. But one of the most important point over here, you have to, rectify your 2022 financial statements also for IFRS 17. And the last point over here, I want to, expedite, and this is very important and crucial for the insurance companies, the external audit review actually. So what happen if the company is remain unsuccessful in the implementation of IFRS 17, and the audit, get appointed, and the audit review has been started, where the auditor has to, review your financial statements and to be published. If the IFRS 17 bases are not fully comply with the standard, then there should be a risk from the auditors. There should be a qualified opinion, maybe adverse or a disclaimer of the opinion. So this is very important. And just to highlight over here, in UAE, most of the insurance companies get a qualification from the auditors on this. I think so. This is a very risk for the company. So, so my suggestion for all my colleagues who work in the insurance companies, that there should be, a pre-plan and a proper planning for that one while implementation of the IFRS 17. So next slide, I will just continue over here. So the implementation of the IFRS 17 journey, like what the challenges as an insurance company we face, might you will face the same challenges, because I think so if we cover these challenges, we will be in a better position when the financial statements, like in 2026, when you are going to, publish the financial statements. So first point I want to highlight over here, the restating of the financial statements of IFRS 4 and IFRS 17. So I think so. This is one of the knowledge where you have to pass to your board of directors. It is very, crucial. And we started this journey, and we, start workshops not only for the company employees, only for the board also. So where we highlighted, like, if the profit are appearing in IFRS 4, it might be different in IFRS 17 due to this and this impact. So I think so. The workshops are very important, and the most important thing over here, which I have want to highlight, your board should be involved in those workshops, which are, it should be maybe high level summaries or something like similar to that. The second challenge we faced within the company and the market, the companies usually do not have in-house actuaries and IFRS 17, experts. Still, it's a very new topic for us in 2019, 2021. So I think so the companies should focus of, hiring some steering committee and in-house actuaries for the implementation purposes. The third point which I want to highlight over here, managed services hiring external consultant for IFRS 17 implementation, can be considered by the companies who are on low staff and looking for, a low budget actually, because our regulator, which is central bank, has given both options, and still in the market we are using both options. So most of the companies in the UAE is still going for this managed services from their appointed actuaries, where they are, sharing the data, and the actuaries are sharing the IFRS 17 disclosures. As I mentioned earlier, like, steering committee is very, essential and crucial for the company while you are planning for the implementation of IFRS 17. One point I want to highlight over here. So it should be not like, from a finance team or some, internal audit team. So it's from like every department, or maybe the, process owners of every department should be a part of this steering committee, because there are many points which is, you have to understand, because once IFRS 17 is published, and when you just see the results, you should understand like why the results are being differ from IFRS 4. Still, we just challenge the same thing, and I think so. This is the very, crucial for the understanding of everyone. The most, I think so. The thing you will just, get in trouble is with the external audit. So now the implementation date for the UAE market is 2023, but somehow we just, started the exercise of understanding with our external auditor, where we just shared our technical documents to them, and where we are, having extensive back and forth discussions on, the numbers. So once you just, step in the journey of 2023, you don't have the plenty of time at that time where we can just discuss the numbers of 2022. So early, or even though early, you have to start this exercise, and you have to share, the technical documents of your IFRS 17 to your appointed external auditors. The next point, which I am just going to highlight over here, the company is failing to implement IFRS 17 appropriately, or missing the deadline, may risk to facing issues and external auditors and regulators. In the UAE market, most of the companies did the same mistake actually. So what happened? They are penalized from the regulator itself, and the bad thing for their reputational risk is like the auditors, grant their qualification on the opinion. Probably the most of the auditors given adverse opinion, which I think so, it's a very risky for the company, for a reputable company. So I prefer, you look all these points which I which I highlighted over here. So we can just go, or your companies in Pakistan can go for a successful implementation. Now, from our experience, like we started this journey in 2009, and in 2023 we implemented the IFRS 17. So I believe like minimum 2 to 3 years are required, which include your gap, design, and implementation phase. In this criteria, you have to finalize your journey with the consultant. You have to finalize the tool. Either you have to, develop your team. You have to prepare a steering committee for that one. So all these points are very necessary. So if you cover all these points, you will see in 2026 you will be a successful, insurer in the market with the implementation of IFRS 17. Still, it's 2024 and we implemented in 2023. Still, we are preparing, our financial statements on IFRS 4 and IFRS 17. But somehow we are publish our IFRS 17 accounts on our website, where you can just go and find www.althafrainsurance.ae, and we are publishing the same accounts to our ADX market. So this is the overall glimpse from my side as a client, and successfully and thankful DD is our partner on this journey, and they are having a very technical team which smoothline our process for the implementation of IFRS 17 on this. Thanks everyone.
Thank you so much, Mr. Hassan, for sharing your experience and journey. If anyone has any questions, feel free to send in the chat box and we will reply at the end of the webinar. Now we will welcome Mr. Ross and Mr. Chris from Green 13 to give us IFRS 17 actuarial system demonstration. Mr. Ross, who is a qualified actuary with over 20 years of experience in the financial services industry, and Mr. Chris, who is also a qualified actuary with over 20 years of experience in the European financial service industry, including Big Four insurer consulting. Together, they will provide demo on this IFRS 17 system, which is used by many insurance companies in the region. Over to you guys.
Thanks very much, Rahim. So Green 13 was founded in the United Kingdom in 2013 by Rob and Chris. So Rob Green and Chris Martis, the founders of the company. And along with Rob and Chris, the three of us are the full-time directors and owners of the company. We are all UK actuaries, and Rahim gave you a little bit of our background there. In the region, I'm also on the IFRS 17 working group of SAMA, coming on to where we're using IRIS. Our business model is basically focused on developing our software to the highest standards we can, based on our own experiences and client feedback, and then to form strategic relationships with highly talented consultancies that have the skills, depth, and regional knowledge to deliver successful client implementations working with you, the clients. So in terms of where our software is being used currently, it's been used for Solvency II reporting for some time, since 2018, and that was extended successfully to do IFRS 17 in one very large UK client. So that client has over £100 billion in funds under management with its latest acquisition this year. It's been used for some time now for IFRS 17, including underlying cash flow modelling and KSA in Bahrain. And it's also used for outsourced actuarial work in Cyprus with one of the Big Four consultancies there. We've got a partnership with another consultancy in Lebanon and the UAE that is working on a number of IFRS 17 implementations across the MENA region currently. And we've also got multiple successful partnerships across the African continent, plus one in Asia with a different Big Four consultancy and one in North America, and with more under discussion, including working with DD Consulting, who we're here presenting with today. So we currently have over 50 direct clients, plus 20 plus more companies using our software via consultancies providing it for managed services. And that's continuing to grow materially. We've got many IFRS 17 implementations underway in the region. So in terms of how IRIS works, IRIS is more than just an IFRS 17 engine. It's actually a complete actuarial and data software package, which has all the tools you need to build successful end-to-end IFRS 17 processes, but can also be used for other purposes in your organization. Indeed, many of the organizations that use IRIS use it for other things, such as Solvency II or reporting, other reporting metrics. So we have tools for data management and validation. So these are easy to configure data management tools, and where you're using those typically in an IFRS 17 process is for things like when you take a policy data extract off your admin system, tidying that data up, cleaning it up, and putting it into the format required for the actual cash flow modelling stages of the IFRS 17 process. It's also used to manage data passing through the process. So one of the areas that can be a lot of setup work with certain IFRS 17 engines is when you extract your cash flows from your cash flow modelling stage, you then have to feed that at the group of contracts level into your IFRS 17 engine. So these data tools inside IRIS allow all that to be automated. So IRIS handles all that internally. We have IRIS-D, which is a data validation solution. So of course, as you'll know, any reporting process, whether it's IFRS 17 or anything else, is only as good as the data you're putting into it. So these tools help you analyze your data going into your process, identify any outliers or problems, and also can be used to give you detailed reports and management information on the data that you are putting into your process. We then have IRIS-C, which is our main actuarial calculation engine. So this is a powerful low-code cash flow and modelling engine. It's been designed by us to be easy to customize and easy to use. And it can be used to do both the cash flows in your IFRS 17 process if you have products that are using those, the revenue calculations if you're using the PA approach, and also it does all the IFRS 17 calculations. We then have tools for IRIS data nodes, which are used to basically extract outputs, build reports and disclosures off the back of the calculations, and also to support audit trails and to allow you to automate the process. So all these components are included in the IRIS license, and I'll tell you a bit more about them in the coming slides. With unlimited use as allowed on your company license, you buy one license for your company. It's not a per user license. And these components will give you all the tools for an efficient end-to-end IFRS 17 or other reporting process. And you can use them, as I said, to build your own processes. And in terms of our pricing, we don't charge any of our clients the fee for the software until the IFRS 17 implementation is complete. So in terms of the main features of IRIS, we'll just go through these quite quickly because obviously time is tight. So you manage your workspaces using our easy-to-use interface. So you do this using a web browser. So all the normal web browsers are supported, Google Chrome, Microsoft Edge. This allows you to navigate, view, and edit all your key data directly using the GUI. You can view and analyze data using easily configurable graphs and charts. You can configure your workspaces how you like. You can open connections to database if you need to upload or download data from databases. And obviously it's through this interface that you control your process and kick off your runs when you're ready and you set up your inputs and so on. Coming on to IRIS-C. So IRIS-C was designed 10 years ago to be easy to use with no complicated code. So again, we've designed it with a simple and easy to use GUI. And we found it's able to be processed very fast. It uses AVX technologies to run models much quicker than some of the software we've replaced. So clients have been able to build complex models using this software, for example, funeral plan models, credit life models, TACAFO models, in just a handful of days. And the models typically require a lot less code than the modeling software where we've replaced other modeling software. But the models are built using simple expressions, so you don't need coding experts in your organization. So if you can build an Excel spreadsheet of your calculations, you'll be using the same functions pretty much in IRIS-C. It's designed to be easy to pick up. And IRIS-C, as well as being used at the heart of all our IFRS 17 implementations we've done around the world, and we've also replaced directly 4 different actuarial modelling legacy platforms, and we've got 2 more in the pipeline where the client's chosen to switch to IRIS-C and replace the actuarial modelling software they're using currently. It also can be scalable on-premise and cloud if you want, although as I said, IRIS is very fast and our IFRS 17 implementations typically don't require a lot of investment in hardware or any investment. So in terms of just some of the key features of IRIS-C, some features to help you understand the results. As touched on earlier, it's very important that your in-house teams understand the calculations you're buying. You don't want to be dependent on a third party's black box. You need to know what your calculations are. So we have our dynamic viewer tool that allows you to trace your results back, shows the value each time step for each selected variable, the input variables that come into it and the output variables that go out to it. And you can track forward and backwards through the calculations. And this works both with the underlying cash flow modeling calculations, the underlying premium revenue calculations, but also the calculations that we've built for IFRS 17 and our IFRS 17 models that we provide. So they're all open to you, and you can trace and follow the formulas and calculations being done. That's supplemented by a parallel spreadsheet. So what this allows you to do is basically it takes the IRIS model inside IRIS-C and it exports it into a spreadsheet form. So it builds a spreadsheet that replicates the calculations. So build a spreadsheet with formulas that replicate the calculations. And then that allows you to use an Excel spreadsheet to check individual policies or individual groups of contracts that you may wish to, if you're debugging calculations. So that supports the dynamic viewer. And it just gives you another tool for those that are more comfortable working in spreadsheets to check and understand the calculations being done inside the software itself. And all our IRIS-C models come with automated documentation. So you can document your models automatically at the touch of a button from the interface when you've got the model open. And that creates a document which uses the underlying model code to write it, but can be supplemented by user-defined descriptions. And that just takes away some of the headache and the overhead of documenting your models. Coming on to IRIS-X and the data transformation tool. So I said typically things like taking large data extracts and converting this to model point files, but also other data transformations that are required in your IFRS 17 process. So really, is your core data going to be the exact format you want for your IFRS 17 calculations? So having a software that gives you data tools to manipulate and change data is really powerful and really helps people that implement IRIS for IFRS 17. So again, the way you build these data transformations, we want it to be open and understandable. So there's no programming. It's not writing complicated computer programs to do these data transformations. You use a spreadsheet by example design. So you map on a spreadsheet your input fields, your output fields, and you build the data transformations you want using Excel formula. IRIS processes that spreadsheet and turns it into an underlying computer program you don't have to worry about. And again, the data transformation tool comes with very similar features to the modeling software in terms of giving you viewers to track through the data transformations you're doing, automated documentation, and so on. In terms of just quickly on some of the other components, so IRIS-D, the data validation, so validates your inputs to your process. So you can point at your data files that you're using. You can set your tolerances for each field in the data that you want to check. So for example, you might be checking that you don't have any ages that are negative numbers, any ages that are more than 100, say, or so on. And I'll give you a detailed breakdown of all the data, telling you how many fields are breaching your tolerances or your warnings, and also a detailed breakdown of what the content of your data is in terms of understanding it for MI purposes. So the breakdown of your ages across your data and so on. Again, that comes with tools to allow you to quickly and simply set that up. This also has IRIS SQL. So where we want to do SQL style data transformations in the process, IRIS comes with a built-in SQL functionality. So this allows you to use SQL queries directly on your data, and that just supplements IRIS-X when you're wanting to transform data and move it around inside your IFRS 17 process. And again, it comes with helpers to allow you to track through your data transformations. And it also comes with documentation feature to automatically document those transformations as you're going. In terms of support for underlying GI calculations, what we typically find is there's normally three parts that are doing all the heavy work in the GI calculation tasks. So you've got your data ETL, your validation and cleansing, your data triangulation, and then your calculations. So IRIS has an open architecture for this, so you're not locked into one approach. And you can parameterize and build as per your own requirements and preferences and skill sets. So as we said before, you've got all the data transformation tools and data validation tools to allow you to process the data quickly, build it up in the formats you want, take those large data extracts and crunch numbers really powerfully. You can then use that to build your triangles or other calculations for exposure that you have inside your process. And then you can use IRIS-C to do the calculations, but you can also use some other features that IRIS supports. So we have an Excel IRIS Tools add-in that allows you to call IRIS-C models directly from a spreadsheet. And you can use this if you want to, for example, do things like testing, pricing, testing loss ratios, and so on. You have open source libraries. If you do use these and you want to keep them, IRIS can call them and link into them from IRIS. So you can integrate them into your IRIS process if you wish. And all these processes can then be automated using the process automation features in Iris. Just touching a bit more on the Iris tools integration. So this allows you to interact with your Iris C models, your data queries and results through an Excel spreadsheet. So you can call models as an Excel function. You can use features like bulk goal seek. You can use this to, for example, check pricing, play around with different pricing, where you want to call the model and run the model with different premium settings. You can do this quickly from the spreadsheet. You have a column where you set your premiums, for example, and it can call the model with each premium. So these tools are just useful tools that allow our users to get the most out of the software and really see the benefit of it. So focusing back on to IFRS 17, in terms of automating your process and what a process might look like, we've got a high-level layout of what an IFRS 17 process might look like in one of our typical clients. So on the left-hand side, you've got what you could think of as your input data. So you might have some economic data you're importing to support things like setting yield curves. You have your policy admin system supporting your policy data. And you may have an accounting admin system, it'll be collecting that actual cash flow information that you're going to need for your IFRS 17 calculations. So as well as projected cash flows, it's very important to be capturing, what are the actual premiums you collected, what are the expenses you allocated to each group of contracts, what are the claims you paid, what are the claims you incurred, what's your outstanding IBNR and claims outstanding, and so on. So all these informations are fed in. You can use the data tools to convert them into the required formats. You also will set up, of course, some modeling assumptions. So for the revenue calculations, that might be things like your earning pattern, if it's a linear earning pattern, or you're using something a bit more complicated. And for products where you're using cash flows, you obviously have assumptions supporting that. So it might be things like mortality assumptions and so on, typical actuarial assumptions. These feed into our underlying models that do the general insurance and life calculations. They'll also be integrated with a risk adjustment model. So the specific risk adjustment model will depend on what your methodology is. The risk adjustment model will be performed in Iris C as well. These feed into our subsequent IFRS 17 modeling stages. They produce your IFRS 17 outputs. Those output files are then used to create IFRS 17 disclosures, used to create the IFRS 17 subledger entries to be combined with the rest of your accounting. And then in most cases, that's then uploaded or fed into the client accounting system to integrate with the rest of your accounting for your non-IFRS 17 items. So in terms of how you have a process in Iris, the IFRS 17 process sequenced and automated in a series of instructions. So the benefit of this is users can focus on setting up the input data and the assumptions and can then run the end-to-end process with a button press. Screen 13 supply a template process and sequence for the IFRS 17 calculations that's then adjusted by the implementation partner, so that might be a company like D&D, to match the specific setup of yourselves, your products, and your methodologies. So they align the standard settings to your particular company, make sure it's complying with your needs. And the system has various tools to allow you to drill down into the process. So on the screen, you see our drill down viewer. That allows you to view every step of the process, analyze the inputs at each stage, the configurations and the models taking place at that stage, and the outputs at each step. So you can trace as your data goes through your IFRS 17 process, and that gives you a lot of visibility, which is very important for when the auditors come to look at it and you've got to explain things to them, and also for your users, of course, to understand what they've done when they were pushing buttons. In terms of outputs, so just standard outputs, we produce a number of all the standard IFRS 17 disclosures required in spreadsheets. So this basically links into the underlying Iris output files and builds the disclosures for you directly. That builds all the IFRS 17 disclosures, but you may also want to combine that with other non-IFRS 17 information. You've got various ways of doing that. You can also integrate Iris with third-party BI, or you can use, for example, Microsoft Power BI. We've built some Iris templates that allow you to build nice charts and graphs using Microsoft Power BI. So you've got some options in terms of building additional reports on top, and it's all fully customizable. So what we've seen is on top of all the IFRS 17 disclosures, you're typically going to want a number of reports for management information to help you validate the results and check them, and to check, things are tying up back with your source data. So you can build and customize those reports, but obviously we supply the software with all the ones that we've developed over the last few years with our experience for our client needs. It's just finally, in terms of the training materials that Green 13 offer. So if a client signs a contract with us for the software, as we said, they don't pay anything until their partners finish the IFRS 17 implementation using IRIS, but we immediately give them access to a range of free online training materials we provide. So that includes tutorials on the system, including IFRS 17 example companies that they can work with to do training videos, documentation, and we maintain and add to that all the time based on client feedback. So if we get a question from a client, and we realize it's not on there, we add new materials. So that's a really useful tool that all our clients and our partners really value. And as I said, that's made available on day one as soon as the contract's signed, before your project starts. So that can help your team build up the knowledge without the dependency in completing the process. They can learn the system in the interim. Okay, so that's the end of my presentation. I think we've just about kept to time, so I'll hand back to the DD team for their next speaker. And as Raheem said, we'll take questions as part of the Q&A at the end. Thanks very much for listening.
Thank you so much. Thank you, so much for the demo, Mr. Ross and Chris. Now we will call in Mr. Hussain Feroz Ali, who is the founder and CEO of DD Consulting and a seasoned actuary with over 2 decades of insurance and consulting experience. He specializes in providing appointed actuary services, leading IFRS 17 implementation projects, and working as an actuarial expert for insurance audit engagements. He will talk today about implementation experience from actuarial's viewpoint.
Thank you, Raheem, and hello, everyone. I hope you are all having a good time, and you are all getting some useful information in this webinar. And thank you so much for joining. As you have seen so far, that our idea was to give you an overview from different stakeholder perspective. So you have heard what are the requirements in Design 3 from Hamza, and then we spoke about challenges from client or insurance company point of view, and Mr. Hassan has spoken in detail about the challenges his company faced. Then you have also seen demo from one of the very strong international company on the IFRS IT software front, and you will also in the shortly hear from another IT vendor. And there is also one segment on for the couple companies where the newly issued AOFE regulations FAS 42 and 43 will be covered. And we are very lucky to have a speaker who was involved in AOFE to work on these regulations. So we will have a first-hand information from Mr. Kashif on that front. From my side, my idea was to speak about implementation journey from actuarial perspective. Me being a qualified actuary, and my involvement in different implementations, and also with different auditors to review the IFRS 17 results. So I wanted to speak about what challenges or how the actuaries can prepare themselves, because there is a lot more dependency on actuaries within the IFRS 17 domain. So to start with, I thought to give you an overview of the scope or the expectations from actuaries within IFRS 4 and how it has changed within IFRS 17 standard. Now, within IFRS 4, if you are one of the valuation actuaries, so you would know that the main responsibility of actuaries is to work on insurance liabilities, and depending on the jurisdiction, most of the times the valuation basis is guided by the regulatory framework. So, for example, within UAE, within IFRS 4 standard, the for life companies, regulatory requirement was not to use any lapses. So same way, and the idea was to have conservative within the IFRS 4 basis, because there is no opportunity to have explicit margins. So the role of actuaries were limited to insurance liabilities, whereas when it comes to IFRS 17, the scope of actuaries have widened to a lot of extent. Starting with insurance liabilities, now the requirement is to calculate it on best estimate basis, which means that you actuaries have to come up with the right set of assumptions. Now, IFRS 17 standard is very principle based, so it leaves a lot on the interpretations. So actuaries now also have to play a leading role in understanding and interpreting the standard and communicate it to different stakeholders. And as I mentioned that there is explicit margins in IFRS 17, which is called risk adjustment. So what methodology to be adopted, how the calculations needs to be performed. So actuaries have to play a role in that process also. The data level is very granular, and the set of data and the requirements in IFRS 4 has changed tremendously within the IFRS 17 domain. And lastly, I would say that the expectation from actuaries has evolved in the sense that they have to play a bigger role in the overall financial reporting. So whether it's P&L review, insurance items review, or insurance expenses, so actuaries have to play a role in different items within the financials of the company. So this was just a high level overview. Now I can also point out some of the specific cases where actuaries have to play a very strong role, starting with data inputs. So, because the level of granularity in IFRS 17 is highly enormous, how the data needs to be structured, or the understanding that what data would be required. So actuaries have to play kind of a role of the bridge. So from understanding from the external software vendor what requirements are there, and communicating them to their in-house IT team, uh, ensuring that the data is correct and properly validated. And most of the cases, I would say that companies would find that the requirement of IFRS 17 may not be readily available within the existing system. So actuaries will also have to work on a plan with their team to start compiling the data in future. Um, then the next is the expenses. So now expenses are required to be categorized into attributable and non-attributable expenses. This is mainly the role of finance team, but actuaries have to work with the finance team to understand the basis and how they have determined these categories. So here there will be the role of actuary in the review of the expenses. Next is PAA eligibility testing and VFA eligibility testing. So I'm assuming that you are aware that there are different measurement models within IFRS 17 standard. Now the calculation of PAA eligibility testing and the assumptions to be used. So some softwares are already doing it, but there you need someone from the consultant side or from the in-house company side to understand and review those assumptions. So here actually will have to play a role. Same way, VFA eligibility testing, which is in fact mandatory for participating insurance products. So here the standard has a few requirements, and actually have to be involved to ensure that the requirements are accurately completed. Then the next is a preparation of inputs for IT system. So whatever system the company eventually decides to onboard, so some level of information would require to be passed on, and there most of the time there will be a set of inputs that will be required from the insurance company. So the actuarial team, either the actuary working in a external consulting, so the that actually will have to understand the requirements and communicate it to the insurance company, and again have to play a role of the bridge, so that the right set of information is going within the system. Actuarial cash flows, I think this is not new for actuaries, that they were already like projecting the cash flows for various products. But here, the because the level of granularity has changed, the if the company decides to use their internal models for cash flows, then those models will need to be modified extensively, or if they plan to use external actuarial models, then you would need someone to have a deep understanding of the products, who can work on the system to ensure that the cash flows are projected correctly, and because there will be a lot of dependency on the actuarial cash flows, because it's no longer, IFRS 4, where actuaries might group the products and do the valuation based if the products have a similar nature. Here you have to divide the cash flows into GOCs and cohort levels. So a lot of calculations are required from cash flow point of view. The next is discount rate, risk adjustment, and various other actuarial inputs, where again some softwares might do it within themselves, but there will be a lot of judgment and decisions that are required to be taken by the company, and the consultant actually try and explain it to the company, so that jointly they can take the decision on that front. Technical paper, which I think you saw in Hamza's presentation, that companies have to prepare technical paper in design phase, for discount rate, for risk adjustment, for cash flow projections, etc. So all of these papers will have certain decisions that the company would need to take, and actually will be at the leading front on to take those decisions. Um, and then I think the collaboration with finance and IT team. So I would emphasize a lot here, that because now the expectation from the actuary is to play a leading role in the financial reportings of the company. So a lot of collaboration is required from the actuarial team, and without the collaboration, I think a company may not be able to successfully complete the implementation phase. Then I would point out the last 2 points for the couple companies. There are additional requirements, and you will hear it in the session when Kashif will talk about it. The queries from external auditor and regulator. So again, even though these are financials, whenever we have seen in from the experience that whenever there are queries from external auditors, so they would expect the actuaries to discuss with them and to explain them, and to give some examples, or to give a reconciliation between IFRS 4 and 17. Actuaries will have to be involved in all those meetings. And again, this is a change from IFRS 4, that when the external audit generally used to happen, so actuaries were never so much involved. But in IFRS 17, actuaries will be leading those discussions, and any query from external auditor, actuaries have to be available to explain and satisfy to the external auditor or to the regulator of the country. Now, I will briefly talk about some of the challenges when you start implementing IFRS 17. So, I have already talked about data requirements. So, the level of granularity is enormous here, and data will be the first biggest challenge for the company. Company needs to have a lot of detail of historical data and assumptions, and depending on the transition method that the company adopts, so this historical data can be very extensive if the depending on the approach that the company takes. Gross and RI data separately. So generally, I think it's more for non-life insurance, that generally the companies were doing the valuation on gross basis and on net basis, because the information on RI was not accurate or not recorded properly within the system. But now standard expects that RI calculations will be done separately. So there will be companies will need to work towards recording the reinsurance information accurately. New data requirement will emerge in IFRS 17. For example, actual cash flows, payment patterns, and some of those company may not have at the moment, so they will have to make a plan so that those information can be captured in future. From system point of view, as IFRS 17 accounting standard will be a new system that the company will have to onboard. So there would be a requirement to either integrate with their existing system or align so that whenever you have IFRS 17 results, so companies can reconcile the numbers with IFRS 4 standard. Documentation of previous assumptions and cash flow. So this will be like a must requirement because in the past when you calculate insurance liability, so in the next quarter it was not required to review what was it that you had projected previous quarter, but in IFRS 17 the expectations that you made in previous quarter will play a role. So that's why the documentation and storage of previous assumptions and cash flows will be a must. Actuarial models, as I mentioned, that those will require to be more extensive and granular, and whether a company uses their internal cash flow model and work towards improving it to make it aligned with IFRS 17 of the actuarial models from the external companies. So whatever the case may be, the companies will have to work towards it. Risk adjustment and discounting assumptions. So this is an area where company actually will have to decide together with other stakeholders. Coordination across departments I already spoke about, and parallel reporting. Now this depends on the country to country. So if, for example, if your country has IFRS 4 standard continue once IFRS 17 is launched, then companies will have to prepare reports on two standards, and there will be a reconciliation requirements. So companies will have to be ready because your challenge will get bigger. That whatever you are doing currently, then you have to do side by side IFRS 17, and then take both the things forward in parallel in future. So companies will have to be ready for this work. Some of the best practices that we can share, which we have learned from our existing implementation experiences, that company will have to have a strong governance framework. So because there are various stakeholders, the responsibilities, who is doing what, because when the implementation starts, you will have a external implementation consultant, you will have your in-house actuarial team, you have the external auditor. So the governance framework, the steering committee meetings, the project planning exercise, so all of that needs to be on top of it, because if otherwise there may be a risk of missing the regulatory deadline. Companies will have to invest in improvement of data quality. So this will be, I mean, insurance companies have generally faced the data quality challenge, but within the IFRS 17 context, every assumption relies and depends on the data. And that's why company has no choice but to invest heavily in improvement of their data quality. Companies will have to invest in advanced actuarial and IFRS 17 software. Training programs will have to be conducted for the in-house staff of the company. Continuously follow IFRS 17 developments, because you will hear from one of the speakers that for the Kaful companies, new standards have been released. So now some companies which have conventional as well as the Kaful windows, so they will have to be prepared how to incorporate these new regulations, and companies have to continuously, follow what new requirements are coming on board. Even in some of the markets, new disclosures are coming out, and which would require companies to understand first and then work with their IFRS 17 software partner to implement those new disclosures. There should be a culture of collaboration across departments. I think this is obviously very understood generally, but within the financial reporting framework, this there was never in the past such a strong requirement that different teams have to collaborate, share information, and work towards completion of financial standards. So there will be a very high emphasis on collaboration. And lastly, I would say accounting policies and procedure alignment. So this point is more relevant for countries where IFRS 17 is already implemented. So now they need to work on alignment of their existing accounting policies and procedures with IFRS 17 standard and enhancements of their internal controls, so that eventually, they are in line with what implementation has happened. And in the last slide, I wanted to cover the three approaches that any company would have, whether you have already implemented or you are in process or starting to implement IFRS 17. So companies generally would have to engage with their external consultant, but there will be a choice that company can go for managed services approach. This approach is useful in the transition phase where if the company is does not have a very strong in-house IFRS 17 experts available, and if the timeline is too short, then the managed service option can work really well for the company where everything is outsourced to an external partner, and the external consultant will work with the company and keep them informed about the different steps. And over a period of 1 year or 2 years, there can be a transition plan where the external consultant would start sharing and transferring the knowledge, and eventually once the company is ready, they can start doing things on their own. The second option is external software purchase. You have already seen the demo from one of the remarkable provider, and you will hear from the next second one as well. This is the second option, that if the company has in-house team, then company can buy the license, and from day one, the team can start learning. Or even if the has the team but they are not confident, so they can engage the external consultant, and jointly companies can start working after purchasing the software. And this is also the option, in fact, some companies have taken up within the GCC market. So both options are equal, and depending on the situation of the company can decide. I think the third option, which is theoretically possible, that the company can develop their internal models, and it can be the actuarial cash flow models, or it can be the full IFRS 17 accounting tool. But from my experience, I would say that there would be probably one or two companies that may have gone for internal development of IFRS 17 software, because there is a lot more sophistication required, and because you are talking about the publishing of the financials, there would be the role of external auditor regulator. So I think this option, I would say 99% companies haven't done their own model. What is possible that once the implementation happens and things are going on in parallel, the company at that stage might think about starting to work on their own model, and when they feel that they are ready, they might switch to their own model. But I think this internal development approach, I wouldn't recommend from day one for any insurance company. So this was it from my side, and hope you find it useful. And please feel free, to drop your questions in the chat box.
Thank you so much, Mr. Hussain, for your insight. Now we will welcome Mr. Mohammad Farhan and Arun from InsurTech for the demo of IFRS 17 system. Mr. Farhan, who has led IFRS 17 implementation for over 15 insurance companies in the MENA and African region, and Mr. Arun, interest lies in insurance and fintech domain, generating technology solution. This system is very well recognized in the market, and I hope you find this demo useful. On to you, Mr.
Thank you, Rain, and hello, everyone. So it's a pleasure to introduce our system, ADAPT, which stands for Actuarial Disclosure and Profitability Tool, to everyone. And basically, this is an end-to-end solution, and will basically go through and show you how uh, it reduces the challenges that the company is going to face, and which were highlighted by Hussein Feroz. Okay. So our background on InsurTech, it is headed by Mr. Rajkumar, who has decades of experience in the MENAP region on implementing software solutions for various insurance companies. And for specifically for InsurTech, we have over 25 global insurance system implementations, and we have over 100 individuals with extensive experience to provide tailored IT solutions to our partners. InsurTech is one-stop shop, so which means that it provides you with insurance core solutions, AML, online portals, mobile apps, everything um, is there within our umbrella. And we do have because we follow global practices, we are able to establish our offices across several GCC countries and India. Okay. Now, more about our parent company. HMS Global is a boutique consulting firm, and it provides advisory on strategy, tax, risk, compliance, reporting, everything. Basically, except external audit, we provide all the services that any external audit firm provides. Right, and we are led by Dr. Abhishek Jaju, who is our founding partner. And through his guidance, we are able to establish our presence in over 9 countries and across 11 cities. Okay. So more on the solutions. Basically, our solution, ADAPT, has been recognized and received several accolades, and was awarded InsurTech Middle East Award, and was also awarded Chartered Risk Tech 2023 Rising Star. Okay, so it's in our solution. Basically, we have a combination of IT, actuarial, and accounting sides, and this is represented by our team. So again, we are led by Mr. Jaju, and then we have Gaurav Bad as our partner, who is the accounting lead. And then we have Mr. Vivek, who looks into the strategy side. Anything IFRS 17 actual is done by me. And then Mr. Satish Meman looks into the AI and tech side, and is, as we have already introduced, Mr. Rajkumar is the Chief Executive Officer and who is the spearhead of our organization at InsurTech. Okay. So a little bit about our journey. We started with in June 2021 and launched. Basically, we started all the insurance company related products. And from day one, we are focused on providing solutions to insurance industry and to help companies overcome several of their concerns in the region, including compliance and AML. And now we are over 100 employees, and we are expecting that this is just a start, and we are continuing to grow. Okay. On our offerings, basically now I'll introduce Mr. Arun, and he will take over and explain our offerings to you.
Thank you, Fran, and good afternoon, team. So basically, if we see, our offerings are scattered across multiple domains. So we have solutions for customer onboarding. We have ERP solutions, as well as we do take care of the B2B, B2C operations for a company. Then we also support the compliance. Then we also support at the reporting and data analysis part of companies, in case if you have pain point. And we also have certain services under our portfolio. So when we see under customer onboarding, we have two solutions. The major one being KYC Digi, which is successfully deployed in almost 200 plus companies, and which has got a good reputation in the MENA region. And we also have video KYC, where we actually do a very seamless onboarding of customer, and that too in a very efficient manner. And under our ERP, B2B, B2C solutions, the main product we would always highlight is our iCore, which is a core ERP solutions for insurance companies. And then, of course, SMRT and IMAP follow the umbrella of iCore. They are portals for SME and retail. And as well as IMAP is a mobility solution, which is related to the core system. And similarly, for compliance, we have multiple solutions. We have fraud monitoring systems. We also have transaction monitoring systems. And then we also have EWRA, which is for enterprise-wide risk assessment. So this is basically, we adhere to the compliance standard. I mean, we have a product and we actually tailor it for the compliance nomenclatures followed by the country in which our client is. And we actually define the rules accordingly, and the solution would be handed over to the client. So that's how it's being working on. And then under reporting and data, of course, ADPT falls under the IFRS 17 reporting. And we also have CECL, which is our IFRS 9 solution. And also we have Rapid, which is our dashboard solution. Like it's a management information software, which is built on top of Power BI. And finally, under services, we have BPS modules, we have business process outsourcing solutions, we have GSE solutions, as well as we are being part of the consulting firm. We, of course, do take up consulting activities as well. So that's a very high level overview of our activities. Back to Farhan. Thank you.
Thank you, Arun. So these are the list of the clients, some of the clients that we are looking into. And then I'll just quickly give you that, needless to say, our software solution takes care of all the three approaches. And it is an automated solution. So any of the approach, for example, PA approach or VFA approach, the eligibility tests are performed within the solutions. Like one of the criteria Mr. Hussain Frozo were mentioning, that it is a requirement of the standard, and our solution automatically calculates the eligibility, and then basically based on that provides you with the output of the disclosures. Okay, now our solution basically is a merger of three departments. So we are not just providing you with a IFRS 17 solution, we are your process partners. So what we do is we do prepare a technical document, one of the requirements that Mr. Hussain again highlighted, and we do help you out with your accounting side and actuarial side, right? The solution is IT driven, and we do help you out with your charter of accounts, and then the final reporting, the financials that are prepared, even that is something that we help the companies with. Now, the solution is vendor and platform agnostic, which means to say one of the challenges faced by the industry, a system overhaul, is no longer required. We try to accommodate as much of the information that is already available, and you try to utilize a system that is already there. It is a modular solution, which means that if the company wants to have cash flows, which are actual cash flows, which again is a challenge for a company. If they want to have that, we can provide that. If they want to exclude that from the offerings, we have a separate module for the accounting side. And that is how we are basically building our solution to ensure that it provides maximum flexibility to the client, and we are able to help them out in whatever way they need. So it's based on the need of the customer, then what we provide. Okay. So few of the key features is that it has a validation checklist and audit trail. So we do have a simple upload and spreadsheet upload, and then there is an ETL upload. And again, the software can be on premise, on cloud, whatever the client needs and their requirements are. We try to tailor-made the product based on their requirement. And we do have a maker checker principle. So the audit trail is there and user privileges are defined. And again, the solution has cash flows, which means that the actual side for IFRS 17 is already catered for within the solution. Okay, so this basically provides you on the workflow. So the core system requirements that we have, transaction data, is very similar to what you have for your reserving, which means that majority of the companies, you don't really need additional help or additional data requirements. Majority of the requirements would be very similar to what you need for your regulatory reserving. And similar to that, we have finance data requirements, which would help you out in getting IFRS 4 numbers. And then when we are providing the financials, which is also part of this, it will be part of that input, right? And for actual inputs, we do have some requirements, but the system do calculate the numbers. If the appointed actuary feels like he needs to provide the input, like I said, it's very customizable. So if the appointed actuary needs to intervene somewhere, for example, to provide ULRs that are more appropriate, if the system generated ULRs, let's say, are higher because of historic experiences, the future experiences by the appointed actuary seems like they would be lower, then he can provide us with the number and we can run the numbers based on that. And then we have the basically actual accounting portion where we generate the cash flows based on your input. Like I said, the data requirements are very similar to your reserving requirements. So you're not really investing into getting additional systems. You are utilizing whatever systems that you have, and based on that, those systems, you are going to utilize, generate the eligibility testing, onerous testing, loss component, discounting, everything. So once the process is completed, we will provide you with the subledgers, movements, IFRS 4 and 17 reconciliation, another challenge that basically Hussain Feroz highlighted, and we will provide you with consolidated and detailed financials. And apart from that, you'll see that if the company wants to dig deep and want granular outputs, financials, we can provide financial at GOC level. Okay, so over here, I'll again invite Arun to take over the key features and data warehouse discussion. Over to you, Arun.
Thank you. So yes, coming back to the key features, we can take it on a clockwise manner. So we have actually two different data sources, like Mr. Farhan mentioned. We can either take it directly from the database or we can feed it through Excel-based files. So when it comes to database, our tool is capable to directly plug into the existing core system, fetch transaction level information, or we even have an API through which the data can be pushed into the system. And then we always take care of the previous data, which means the subsequent measurements are automatically handled for in any case. And we actually follow a workflow kind of methodology. So all the actions happens in different stages. And the entire operation, whatever happens from the data spooling till the output generation is auditable. Like we can stop when and where we need. We can audit the data for its for the output as well as the quality of data segregation, and we can decide on whether we would like to proceed or not. And we also have various controls which are put in place to handle and ensure that the data processing happens on quality basis. And like Farhan had said, several actuarial calculations happen within the tool. For example, risk adjustment calculation as well. And finally, the IFRS 17 model points are generated as output. And once we have the model points, again, we have certain dynamic capabilities wherein the tool is capable to define certain libraries and then generate the IFRS 17 output based on these libraries, with which I mean, in case if there is a new nomenclature which gets applicable starting from third quarter of 2024, we can define a separate library to incorporate that functionality, and all the subsequent runs would take up or would refer to that library to generate the outputs, wherein any previous run when you're making, which does not need to actually include that particular nomenclature, can be executed following the previous library. So that is one additional functionality. And since we had mentioned that our tool is platform agnostic, we are even available to work under the AWS solutions. So we can utilize the AWS capabilities fully and execute and give the numbers. So that's on a very high level about our key features. Back to Farhan now. Thank you.
Thank you, Arun. So where I want to highlight one more thing. One of the key features that is not mentioned here is that our solution is designed for FAS 42 and 43. So we do have adapt that is going to provide you solutions for takaful. So this is built on the discussion we had with IOFE on the approaches to be followed, and based on our discussions, we had published articles on the financials that are published under IFRS FAS 42 and 43. Okay. So again, our methodology is basically we have all three models, and we do cater for insurance and reinsurance separately. And one of the things that Hossein Feroz mentioned is the challenges that the company is going to face because the data they have is on gross and net basis. We take the data at gross and net basis and then get out the reinsurance numbers from them. So we try to modify our workings based on what is available at the company level. And then the system calculates OCI and base, subsequent measurements. So initial and subsequent measurements. So basically the initial data, whatever data is there, it is automatically stored and it's used to generate the outputs. The loss components are calculated, VFA approaches are followed, roll forward is followed. So everything that is that Hossein Feroz highlighted as challenges, because we have learned through our implementations, we have modified our tools to ensure that those challenges are more or less reduced for any implementation that is going to adopt our software, right? And uh, again, Mr. Hassan Salim, who is from ADIC, our solution is also there in ADIC. And the challenges that you were talking about, we have learned through them and we have modified, and this is the output that you're looking at. Okay, so now we are going to just highlight how our software actually looks and what it represents, whatever information you have you might need for this. Okay, this is the dashboard, which provides a very high level view of what is there in the data. And what we are trying to do is we are trying to get as much information from the company as possible at as granular a level as they can provide, and then utilize that to project the numbers and to generate the output, right? So once the data, this is the dashboard. Once the data is uploaded, we do have validations that happen, and even the validations are customizable. We do have preloaded numbers of validations, and if we have any failure, so the reason for that failure is highlighted, and the company can rerun the numbers, re-upload the information, and then rerun. And if the company just needs to upload a section of the inputs, even that facility is available within our systems. Like I've mentioned, we are more of a process partner than a IT solution, and we try to accommodate clients and try to customize our system to ensure that the efforts that are put in by the company are minimalistic. And once this is how we are actually going to upload the we do have a set template if the company is requiring a spreadsheet template. If the company has any provide us the information through their system, this step would be skipped. And once the template is uploaded, all the information is calculated and provided to the company to ensure that they do have a rough picture of what is happening. So, for example, as soon as the data is uploaded, it will provide them what exactly is the GWP, what is the earned premium calculated, UPR, etc., so that they do have the confirmation they need to ensure what data they uploaded is correct. If they are uploading it for a certain quarter or year to date, it depends on the company, and we just have to define it within the system. Once the systems are data is uploaded, we basically generate the payment patterns and risk adjustments, and then we allow for corrections, ULR corrections, if you look at it. So what we are trying to do is we are trying to make sure that the appointed actuary is very comfortable with the system that we are providing. If the appointed actuary is not comfortable with the risk adjustments, which highlight the volatility of the data, the appointed actuary can, let's say, modify it to, let's say, 5%, right? Any percentage that he feels is more appropriate, we will be able to use that and move forward. The payment patterns are calculated based on the historic payouts, but let's say there were challenges and there were cases because of which you had a different payment pattern, and the opponent actually feels that the payment pattern for the future would be slightly shorter. Even that can be implemented and is implemented within the system. Apart from this, we do have sensitivity analysis within the tool, which highlights different various scenarios, changes to discount rate, profitability, and payment patterns, risk adjustments, and all such things. All of them are within the system. Okay. Once we have this portion, this module that you're looking at is the cash flow module. So this is where the actual workings are happening. We are calculating everything, including the loss component and the eligibility testings. Once this is run, then we have this next module, which is the adapt module. The output from the cash flow module forms the input for the adapt module. And this modular formation ensures that the solution is most cost efficient, which again means that if the company feels they can provide us with the inputs for the accounting module, we are more than happy to just stick to the inputs that the company provide in a certain format, and then we can generate the output based on that. And this is a dashboard, so it shows you what the reasons for the changes are happening. It provides you a highlight of what the waterfalls, what the movements are looking like. And again, all of our numbers, all of our results that you see can be generated at a GOC level, not just at a portfolio level, but at a GOC level. So we can see it over here. So if you're comparing, this is very helpful from the management. So if the management wants to compare how a certain underwriting year were performing, let's say 2022 were performing, they can compare 2022 underwriting year against 2023 underwriting year within the workings. They can see the CSM movement, loss component movements, and the reason for that movement. Everything would be provided, and they can make a call. This would reduce the ambiguity that is present, and when people are actually looking at, let's say, the losses, the current year losses, for example, the losses might be driven by the policies that were written in the previous year. This ensures a better transparency, and it ensures that one of the KPIs for underwriters, because the standard is to highlight how the underwriting performances are happening. So one of the KPIs for the underwriters are their combined ratios, and through this, the underwriting performances for certain period can be highlighted and rewarded. And similar to how we generated the water flows, our results are then generated. They again can be generated at the consolidated level and then at the portfolio or GOC level. So we can generate all the disclosures, order revenues, expenses at a very granular level. And this ensures that the company is able to make decisions on closure of certain business lines or informations on what the product is performing under certain years. So all of this is because of the information that we are disclosing to them and the level of granularity that is available with us. And again, once this is done, we do have IFRS 4 versus 17 comparison built into the system, which highlights what are the reasons for the differences between 4 and 17. And then based on that, the company can decide what really impacts them. For example, the new terminologies that we have, risk adjustment, discounting, all of those things, and the CSM, everything would be mentioned over here, and the company would be able to highlight what is happening. Apart from this, we do help the company with chart of accounts, the new accounts that would be required in the standard. And if they are going for a parallel runs, so we would be able to help them with what needs to be added into their system or into their output to ensure that they are able to sustain both the trial balances. And this provides the company with more of an end-to-end solution than just output generated for IFRS 17. So I leave the floor for a question for at any later stage after the presentations are done. If you have any queries, feel free to reach out. Thank you. Over to you, Ring.
Thank you so much, Mr. Mohammed Farhan and Arun, for the demo. I would like now to invite our last and our special guest for today, Mr. Kashif Siddiqui, who is a fellow chartered accountant and has an extensive knowledge in the insurance and takaful industry. He has held prestigious leadership roles at renowned national and multinational organizations and regulators, including SECB and Financial Service Authority Oman. He is a member of Takaful Accounting Committee, wherein he was involved in the development of the latest financial accounting standards, FAS 42 and 43, aligned with IFRS 17 and Sharia compliances. Mr. Kashif, we are eagerly waiting to hear from you your invaluable insights on this topic.
Thank you, Mr. Rahim. And I'm very much, thankful to all of you, especially the DG Consulting, who is organizing such a informative webinar, and also especially the participants who make this success. And thank you for inviting me to speak something about the takaful to this August audience. And as we know that the takaful is something different from the conventional insurance, being reason that the conventional insurance is has some elements in the processes which is not Islamic. That's why under the Sharia principles, because they are not dealing in the Islamic way. So the takaful, this is an Islamic insurance, alternate of the conventional insurance. So that to bring in all the Islamic, principles and the rules inbuilt within the process. Because apparently the outcome or the result of any transaction or operation doesn't make this thing, the product, haram or halal or Sharia compliant, non-Sharia compliant. Actually, it's the process which is adopted or the transaction which is adopted for the kind of the for the process adopted for this transaction. So it makes the haram and halal or Sharia compliant and non-Sharia compliant. Because if we are not adopting the right process for some transaction, so there may be some kind of the elements which attracts some kind of the non-Sharia elements like riba, gharar, and qimar. So that's how, in principle, the Sharia says that the conventional insurance company, which is being operated right now in all of part of the world, so they have the processes which is not aligned with the Sharia principles. That's why the takaful actually is introduced, which has eliminated all these kind of the elements. So what happened actually? Let me move forward. That the AOP is an organization. It is an auditing and accounting organization for Islamic financial institutions. Is actually an autonomous non-profit corporate body which develops standards for accounting, auditing, and the Sharia governance and ethics standards for Islamic financial institutions, which includes takaful. So very recently, AOP has already issued for FAS 42 and 43 for the takaful accounting aligned with the IFRS 17, and which includes the principle of Sharia and takaful structure and model itself. I've been the part of the development team for this FAS 42 and 43 on behalf of the AOP. So it's a very, I'm going to share some kind of the historical timelines for this standard. If we talk about the, some way back when there were no standards at all for insurance or takaful, AFI was the organization who has started showing, series of the standards on Islamic insurance. In 1999, they issued the first standard, FAS 12, for the presentation and disclosure of the Islamic insurance companies in their financial statements. Then onward, they issued FAS 13, FAS 15, FAS 19 from 1999, 2000, and 2001 and 2003. Then later on, in 2004, ISB has issued the IFRS 4. very first time. And obviously it was not a full accounting standard. It only caters some kind of the, disclosure requirements only. So if we see afterwards, IFRS 17 was issued for actually having all the parameters for the accounting and reporting both for the insurers. Then after that, in order to have a harmony in the industry, because both belong to the same industry, one is a Sharia compliant and one is non-Sharia compliant, but it belongs to the same industry. So what happened actually, the AOFE has built, the standards in a way that to enhance the compatibility and to do the harmony in the industry, and it will good for the regulator also, so that to adopt the one standard for Islamic and the other is for non-Islamic. So because we feel that this IFRS 17 cannot be adopted very straightforward for the takaful industry. So there is a need for some changes. But because the IFRS 17 has not addressed those needs or changes, so obviously FE has adopted some FAS 42 and 43, and that is the accounting standard now, which is FAS 42 is for the presentation and the financial statement, and FAS 43 is for the recognition and measurement of the accounting. And it is very much Sharia compliant, and it actually inbuilt the structure of takaful itself. So which IFRS 17 is not addressing in their standard. So what happened? FAS 42 has repealed the old standard, which was FAS 12, which was issued for the presentation and disclosure, and FAS 43 has replaced and superseded three phases: 13, 15, and 19, which are initially for the disclosures of the surplus and deficits and their determination, and the provisioning, tactical reserving, and other was for contribution for their accounting and reporting. So these all four standards now superseded: 12, 13, and 15, and 19. Now the new standard 42 and 43 is to be used by the takaful operators. Either takaful operators, either the window operations of the commercial insurance. So there are some elements which I'm going to highlight. Why straightforward we cannot use IFRS 17? Because there's a difference in this in the conventional insurance and the takaful operations. So for example, the regime of the conventional is to transfer the risk from one party to another party. However, the takaful, which is Islamic mode of the conventional insurance, so it's the Islamic alternate is takaful. So actually, it is depending on the risk sharing model, cover model. So that's how here the gross revenue is not premium, and here we say contribution. Some people say it's just the name of the terminologies. It is a change of terminologies only. No, it's not a change of terminology. The science behind that is totally different. For example, if this is an insurance company, it is managed by the shareholders. Okay, overall, in the takaful, it is managed by the shareholders, but on behalf of the participants. So for example, if there is a surplus in the underwriting, it can be issued to the shareholder in insurance companies. But if there is a surplus from the underwriting, then obviously it cannot be distributed to the shareholder. It has to be distributed to the participants. So it's a big difference. So if the income is generated in the insurance companies, all type of the income can be reported to the shareholder fund. But here, all income cannot be reported to the shareholder fund. There are some limitations. They are, for example, all the underwriting profit cannot be shared to the shareholders. Rather, only the wakala fee or mudari fee which they've earned for the management of this takaful fund, they can take this earning only. If there's a deficit, obviously in the insurance company, all the deficit has to be borne by the shareholder ultimately. But what happened in the takaful? Shareholders are not supposed to bear this deficit, but for short time, for temporary purposes, they give loan for the future sustainability. And once the surplus is generated in the participants, then they can take it back. And this is without interest, because under Sharia, interest is not halal, is allowed. So obviously, this is interest-free loan to the participant. Why this condition is applicable? Because shareholders are actually responsible for managing this fund. So it is their duty to fully responsibly manage this fund. So and should be ended up with the surplus. Might be they are charging higher wakala fee that time. That's why they are in deficit. So that's why it is a legal responsibility. Under the legal regime, it put a responsibility on the shareholder so that they can pass on some concession to the participant. So that's how these kind of the elements is not available, the concession type of thing in the convention. Similarly, the funds, we can mention all the type of the insurance fund with the shareholder fund together and report on the consolidated basis. But for the insurance, Islamic insurance, takaful, they cannot obviously they cannot merge all these funds together and report. They have to maintain separate statements and separate funds, separate asset and liabilities, separate income, separate expenses. So their reporting also different, cannot be consolidated. And losses obviously has to be borne by the shareholder, not the participant. Expenses here, if we are going to adopt IFRS 17 and for the convention, let's see, all expenses are borne by the shareholder. You can use all the expenses in our calculation, but here there are some segregation in the Takaful fund. Takaful fund In the Takaful fund, for example, selling and marketing administrative expenses cannot be borne by the participant, rather only shareholders. Here, all the expenses are borne by the shareholder, but the Takaful, no, this selling, marketing, admin expenses has to be borne by the shareholder. So in Takaful, what only allowed is a Takaful related things, for example, the claim or retakaful operation contributions. And so in the insurance, we see this is only one accounting entity altogether. But in Takaful, which feel under the one umbrella of the legal entity, there are two virtual accounting entities inside. And we are dealing differently for these two funds, shareholder fund and Takaful fund. So how we can apply very straightforward is IFRS 17 even for the both two organizations, which is primarily very different altogether. So for example, in case the conventional insurance company is going for liquidation, what happened? Whatever the remaining surplus or deficit, it will be transferred to the shareholder. But this is not the case in Takaful. So primarily what happened? If there is surplus, okay, you can distribute to the participants. But it says if you are going to liquidate this company, the Sharia standard says primarily you should approach to other registered Takaful operators so that you could pass on this portfolio to others, so that the participants can continue with the other registered operator, and or maybe they are supposed to give the charity to the other to the welfare organization, and it is not supposed to distribute to anyone. So these are the Sharia issues, which is not considered to be available in the insurance. So how it's going to affect now in accounting and reporting? This is the primarily differences in the Islamic and non-Islamic insurance, but how it's going to impact in our current regime of accounting if we don't apply IFRS 17 or if we apply IFRS 17. Let's see. The participant fund. Participant fund are not under the ownership of the shareholders, first of all. The shareholders are actually managing these funds in the fiduciary capacity or held on trust basis. So shareholders are the owner for their own fund, but those funds which belongs to the participants are not supposed to under the ownership of the shareholder fund. So whenever there are two funds and this shareholder fund are actually managing only the participant fund, so it means in the fiduciary capacity as a trust basis, these are just a managed funds. For example, in the asset management company, what happened? One company is a legal company, which is asset management company, and they have multiple funds. And what they do, they don't consolidate their numbers. They issue their financial statement differently. Management company's financial is different, and funds financial statements are different. They cannot merge together. Both entities' position is different, and this fund is not under the ownership of the management company. But because they are responsible to manage this fund, so that's how whenever they do audit for their numbers, they also present the funds number as well, but differently, as an off-balance sheet item, as a managed accounts, as a managed funds. So similarly here, if the Sharia principles say, or even in the principle of the main accounting principle, because Sharia issue is not only the issue. This accounting principle is this, that for conventional there is no two set of accounts, but here we have two set of different responsibilities to managing these funds, including the shareholder fund and the participant fund. So that's how in our IFRS 17, obviously we cannot consolidate with these numbers. So it means for Takaful, we cannot straightforward apply IFRS 17 because everything will become into the one number, which is not possible under the Takaful regime because Takaful model and its structure is different from the insurance. Secondly, for example, discounting is one of the Sharia issue that under Sharia we cannot say that actually the Sharia doesn't realize that under Sharia principle that the time value of money is not to be considered actually. For example, if there is some established liabilities, then if established liability means this amount is due on day one, it may be settled on the spot, maybe on a deferred basis. But the problem is this amount now cannot be changed. because it becomes then under the Sharia. Once it becomes then and it has established liability, or maybe it's vice versa. It may be the liability on one part as an obligation, or maybe the right to receive something, but it cannot be changed further because of the reason that it is an established liability. It cannot be discounted because this amount cannot be changed. But yes, if you are talking about the provisions or making some estimates, there's no harm to apply any discounting because we are not, this liability is not established that we are going to change, because then cannot be changed. Established liability cannot be changed. We have to settle on the same amount, either it is deferred or on the spot. So that's how for the provision is just used for the estimation purposes, which is not a contractual amount. So that's how this IFRS 17 doesn't say anything about this. So how we will allocate which elements has to be discounted, which element has not to be discounted if we are using the DCF method for fair value, valuation. So how it is possible to apply IFRS 17? So this is an fact that where we cannot apply IFRS 17 as it is for the capital operators. CSM computation, actually the whole CSM computation is actually based on the fulfillment cash flows. And the fulfillment cash flows, there are some expenses which insurance allowed to incorporate in that calculation. For example, the commission, agents or broker commission. In Takaful, it is a part of shoulder fund, not the Takaful fund. So Takaful Parchment Fund cannot, cannot accommodate or account for this kind of the acquisition cost, which includes commission for the fulfillment cash flows calculation. It affects the CSM calculation as well. So if the CSM calculation cannot be same, so how we can adopt the same principle for IFRS 17 for Takaful actually. For example, all the income which is generated from the non-Sharia compliant, including, for example, any commission which we generate, Takaful companies generate from the reinsurance side, any commission. Under Sharia standard 41, it doesn't allow. If you have even generated some income because of the issue that we couldn't find a re-Takaful operator to take your risk, okay, because of the non-availability of the capacity or not sufficient terms and conditions. So might be you go to the reinsurance side, commission side, but only the claim is allowed to be recovered from the reinsurance, conventional reinsurance, but the commission is not allowed because it thinks that it is the participation in the profit, and profit generated from the reinsurance is not Islamic. So that's how once the commission is generated in your business from the reinsurance, it has to be made to pay to the charity from the PTF. So there's a difference. And the concept of seed money hiba is not available. For example, if you are a Takaful operator or into the Takaful operator, once you start the operation, you have to, from the day one, you have two different set of accounts or funds. For example, shareholder fund and the participant fund. To establish one bank account in the PTA or Takaful fund, you have to have some initial deposit to open the bank account. From where this money will come? Obviously from the shareholder. They will give some money to start some operation as a hiba or maybe seed money. In the start, it is called seed money. And in seed money, accounting is different. It's not income and expense. For example, it is expense part. And if there is a irrevocable, commitment that that amount paid, it will not be repaid back by the Takaful fund. So what happened? It will become the expense of the shareholder fund, and it become the equity of the Takaful fund. These things are not dealt in the IFRS 17. So if we talk about the consumption requirement, already have explained when there is a deficit, then shareholder fund are supposed to give some consumption to the participant fund so that they can generate some surpluses in future, then they can revert it back, pay it back. So these things which are not dealt in the IFRS 17, so obviously FAS 42 and 43 has come up with the solution and the accounting treatment along with the disclosure requirements. And some other parts, for example, acquisition cost, which I've already explained about the commission, which cannot be treated as it is like the conventional insurance. Wakala fee, there is no concept of the Wakala fee under the IFRS 17 for insurance companies. This is the only fees which is going to be generated by the shareholders from participant fund. And this fund, now participant fund, this is actually the insurance accounting or FAS 43 accounting is to be applied for the Takaful fund, not for the shareholders fund. So it means the Wakala fee to be treated as an expense and maybe the part of the, the fulfillment cash flows. But here, what we do here in the insurance, and here we incorporate all the admin expenses, selling expenses, commission, but it's not allowed on the Sharia. If we talk about the technical reserving will also change because if the fulfillment cash flow elements is changed, obviously the technical reserving part will also be going to change, even in the LRC or maybe also in the CSM side also. And not only this, for example, if we have parked some kind of the liabilities in the LIC, it allows for the long-term liabilities. The LIC has two parts. One is the reported, one is unreported. Unreported is based on estimation, which can be discounted for, but for the liability which is incurred and reported, but this is the established liability, even if it is going to be settled more than 1 year, then in the insurance it is allowed to be discounted, but under the Sharia standard or Takaful standard, it's not allowed to be discounted. So these are the major differences. So ultimately, because of all this the profit competition will become changed. So it is not 100% same. So because the underlying principles are changed, so the profitability, asset side, liability side, so all numbers are going to change, and it's a major impact on the financials in terms of accounting and reporting both. So what I feel, and I am very much 100% believe that IFRS 17 cannot be adopted 100%. And thank you very much for all of this. Up till now, we have been conducting for FAS 42 and 43 trainings around the globe for the regulators as well, for the insurance and Takaful companies as well, in Takaful operators and those insurance companies which have their window operations, especially Pakistan, for example, there are a lot of window operations. So there might be a need, because if the Pakistan or other countries are going to adopt IFRS 17, and if they have some windows, so obviously they have to take the learning of FAS 42, 43 as well, along with the 17, and have some, designing phase also along with IFRS 17 for the FAS 42 and 43. So if anybody want to contact me, I'm very much available on the kashif.siddiqui@globalfeasibility.com. I'm the partner in the Global Feasibility. Global Feasibility is a financial consulting and auditing company operating in Oman. So thank you for your patience listening. Thank you for participants, and thank you for the organizer. Over to Mr. Rahim.
Thank you so much, Mr. Kashif. Thank you so much. That was indeed very informative. Now we will go for the question and answers. We have a lot of question and answers coming in, and I think so there's one for Mr. Kashif. The question is, are these requirements applicable to Malaysia, Indonesia, etc., where the Tagaful models may be different?
Yeah, thank you for your question. It's a very good question, by the way. And under the FAS, Takaful actually Islamic insurance, and globally there are different kind of models are being used to adopt Islamic insurance. For example, in the Middle East and then North Africa and in the South Asia, people are using the Wakala model, Wakala Waqf model. And for example, in Saudi Arabia, there's a Tawni model, cooperative model. In Malaysia, there's a Mudarba model. So models are different. And it is very sure the FAS 42 and 43 has specifically identified that this standard will be only applicable for the Wakala and Wakala Waqf model and shall not be applicable for Mudariba and Tawni model, means cooperative model. So I'm very sorry to say this standard is only applicable for this type of the regime. And we are working. I've been the deputy chairman of the IFSB Malaysia also, Islamic Financial Service Board. I've developed many other standards also for the regulators. So what happened? We are trying to engage the AOFI and IFSB to develop some accounting standards for these models also, because one model cannot fit for all. One accounting standard we cannot fit for all models. So this standard, which is recently been issued, is only for the Wakala and Wakala Waqf model. And hopefully in the future, we will get some new standards for Mudarba and Tawli model as well, inshallah.
We are getting a lot of questions for you only, Mr. Kashif. So the other one is
most welcome. Please go ahead.
How do the measurement models for the insurance contract under the IFRS 42 and 43 compared to the general measurement model GMM and premium allocation approach PAA under the IFRS 17? And what are the key differences? What are the key differences in the initial and subsequent measurement of insurance liabilities between IFRS standards and IFRS 17? Moreover, if you can explain what are the key difference in the treatment of the acquisition cost?
Yeah, thank you very much. Very good question. Although it's a little bit, lengthy to answer that, but I'm just giving you a short, brief answers so that in detail we can have separate session for trainings for that. But see, first of all, your question about the acquisition cost. Under the principle of insurance, this is only one fund. You can dump everything there and take out the profitability out. But here in Takaful, you have to identify which element you can record in which fund. For example, there's shareholder fund, there are Takaful fund. Acquisition cost has two elements under the FAS and FAS for FAS 42 and 43, not like IFRS 17. If the acquisition cost related to the commission, selling and marketing type of things, then it has to be the part of the shareholder fund and has nothing to do with the Takaful accounting. Second part, if any acquisition cost which is incurred at the time of acquisition in terms of, for example, risk inspection charges, maybe the medical fees which you have incurred, or any other charges for documentation or legal charges you have paid. So it means this is a direct cost which is incurred before the acquisition of the policy even. So it means this kind of the cost is called acquisition cost, okay, which has to be accounted for in the Takaful operations. But the commission type of the acquisition cost, either you have paid to the agent or your brokers, it has nothing to do with the Takaful operator. It has to be, not to be in the Takaful fund, it's had to be charged to the shoulder fund. So once it starts with shoulder fund, so it means it has nothing to do with the CSM calculation or fulfillment cash flows, nothing, because the standard is not applying to the institution or the operator, is rather only to the Takaful fund. Okay, while calculating the liabilities or profitability, I have mentioned some of the elements. For example, while calculating the fulfillment cash flows in the insurance, we consider, for example, whatever you have. But I'm telling you what is the difference. For example, wakala fee. Wakala fee is not the part of fulfillment cash flow in the insurance. Then, but it will be the part of the CSM calculation in the Takaful fund. You know what is Takaful? What is wakala fee actually? Wakala fee actually a fees which the shareholder fund is going to charge to the participants for what? For administrative costs, for selling and marketing costs. Even the wakala fee has built in some sort of profitability also for the shareholders. So it means the profit of the shareholder, their administrative costs, their selling costs, which is also built to recover some commission costs also. So it means all these costs has to be borne by the Takaful fund, and it would be the part of the fulfillment cash flow. This is the big difference. Second, the big difference is discounting. If we are going to apply fulfillment cash flow and to arrive at a fair value through discounting, discounting is not to be allowed on across the board of all the cash flows. You have to identify which cash flows has established liability. For example, any kind of a liability, for example, wakala fee. Wakala fee is now due. Wakala fee, once that you have received the contribution, the wakala fee is now due. You have to pay to the shareholder fund. Now, even if you pay after 3 years or 4 years, you cannot be discounted, which is because it is agreed. Now it becomes then. It is established liability. Under Sharia, you cannot discount it. So for each element that you have forecasted or estimated for the future fulfillment cash flow, you have to identify separately all the elements which can be discounted, which cannot be discounted. So this is a big difference actually. Straightforward, you cannot discount every item in the cash flows, just like insurance. And so that's how there's a difference. And
yeah. So does FAS 42 and 43 provides direction on accounting treatment of the income wakala and expenses commission GNA in SHF?
Yes. Yeah. It will be the income of the SHF and it will be the expense on the part of the Takaful fund. Even the income, as per the FOS 43, is not 100% income, can be charged or recognized in the day one when you have received or about to receive. It says it has many elements. For example, because you are in the receiving end by the shareholder, they are receiving end of the wakala fee. Why they are receiving this wakala fee? To provide service up to the maturity of the policy, up to the entitlement period of the policy. They have to provide service. They have to keep their claim department active. They have to bear the cost. So it means there are 2-3 elements behind this wakala fee. Some portion which you have already provided service, for example, for underwriting or pricing, or maybe the acquisition type of things. So some part of the wakala fee can be treated as income in the shareholder fund right now, but not maybe the other part, for example, those services like claims, settlement, or IT services, which you have to provide up to the maturity time of the policy for the remaining coverage. So it means some portion of the wakala fee you have to defer in your income and amortize over the period. So it's not that straightforward. Yes, it is now, the IFRS has already, developed the regime, how it need to be accounted for and how it's to be reported. Yes.
Okay. FAS 42 and 43. Requirements are new. How insurance companies can make themselves fully aware of these regulations? Are there any training available for Takaful companies?
Yeah, obviously, for example, myself, I've been conducting many training on behalf of AOFE and on behalf of my company as well. For example, in April, on behalf of AOFE, I conducted training globally, virtually, on a global basis. All the regulators from the globe and all the industry from the either insurance and the corporate, both were there. I conducted 2 days training. There are a lot of questions from their side, from the global regulators and others. And physically also, for example, I went to Nigeria, Lagos, to train their regulator for FAS 1443. They say, we need, Mr. Kashif, I know we attended this virtual course, but we feel your physical presence. I said, okay, no worries. I went to the Nigeria to conduct this training because the benefit of the face-to-face training is higher as compared to the virtual trainings because there are lots of eye contact, participation, feedbacks, question answers. So for example, yesterday I finished my one of the training with Al Madina Takaful in Oman for the 4 days. It's a 4 days training. They booked the full ballroom of the hotel, and there were lots of participants from their own company. It's dedicated training for the 4 days. Just finished yesterday. So and also I've been in touch with very many insurance companies and the couple companies in Pakistan as well. They are also looking for me for the on-road training as well.
How would VFA measurement model work under IFRS 42 and 43?
Exactly, there is no such difference between the model which we are using for the GM and the FAS. What is the difference in the GM model and the VFA in the IFRS 17? Same difference we'll be having, but the issue is the fulfillment cash flows which we have done and the discounting factor we've done. Sharia compliant, only that difference will be there. Other difference is the same as the IFRS says.
Okay. Generally in Middle East, companies charge high wakala to
Hello, Rahim.
PTF. Yeah.
Sorry, in the interest of time, maybe we can stop here and some of the questions we can respond via chat.
Okay, surely.
Okay.
Because yeah, there's a lot of I think that there's a lot of queries mostly especially for FAS 42 and 43.
Maybe because I was the last speaker, that's why.
And also the topic is also, I think it has a lot of curiosity, especially within the couple companies. But because we have like almost 2 hours, 15 minutes already completed. So,
Then, yeah. So thank you everyone for joining in. And soon we will be sharing the link for this live webinar on our LinkedIn page, and you can all join it from there. Thank you for coming in and thank you for giving up your time. And if you have any questions regarding any of this topic today, you can email us at support@diditsdata.com. Thank you.
thank you to the speakers as well for sharing your insights. Thank you so much.
Thanks very
Thank you,
much.
everyone.
Thank
Thank
you,
you for your
everyone.
patience.